Um, in terms of sort of, understanding auditing from a historical perspective, uh, this is a general way of looking at it. I hope you recognize the picture, the image
Yes.
from the movie Batman, right?
I didn't recall the movie, but the picture I've seen it somewhere, I believe. That's all.
Yeah, if have you watched any Batman movie or a cartoon?
Yes, I did, but it was a long time ago.
Yeah, but I mean, Batman in the movie, so Batman, Bruce Wayne is a very rich billionaire, right?
Yes.
And he has his father's business, which he owns, but his entire business is run by somebody else called Alfred, right? So
Yes.
it's like his butler, but Alfred
Correct.
is the guy who runs the whole business. So in this picture, in this particular movie, the guy who is seated is the Batman. He's the owner of Bruce.
Bruce business
It's not Bruce. I think it's Wayne Industries or something, right? But he owns it, but he doesn't really get involved in the business, right? He doesn't make business decisions. All the business decisions are taken, and all the businesses are run by this other guy, the older gentleman, Alfred, right? The reason why I put this picture is that, so I mean, the rest of the slides are pretty boring, right? Because it's very technical stuff. So I thought of sort of adding some excitement to this, at least to start with. So this is called stewardship, right? Stewardship is when you have the business entity which is owned by somebody, and we call them owners or sometimes principals, right? But then they don't really manage the business. They pass that task to somebody else who we call stewards, right?
Okay.
But in modern days, we call them managers or agents, right? So these stewards run the business for the owners, right? And they are responsible to report to the owners of the business, right? So this idea of stewardship is also it has also come to accounting.
All right.
So when it comes to accounting, the accounting task of the business is also sort of done by somebody else. I mean, if you think about an organization, you have an accounts department or a finance department that the accounting part is passed on to by the owners to those managers, finance managers, accounting manager, whoever, right? And that team. So they do that. And in some cases, you have completely outsourcing the accounts function. You see this in a lot of small and medium-sized businesses where a service provider, chartered accountants, and accounts firm does the accounting part for the organization, right? Now, what happens is the owners will need to know that the managers have done the right thing, whether it is accounting or anything else, right? It can be HR, can be marketing, whatever. But whatever the task that has been sort of passed on to managers, they will obviously report to the owners, how they did it, and in terms of hard numbers and incidents and cases, whatever, right? They will sort of keep the owners up to date. But then the owners would also need to know that are they reporting accurately?
Okay.
Right. So that's where auditing comes in, where they would need somebody else to tell the owners that these managers, the agents are reporting accurately or not.
Okay.
Right. So that's how auditing sort of fits in with this sort of stewardship, the idea of stewardship. Right. Now, when you read up a little bit about the history, I mean, it's the history of auditing is not that complicated. It generally evolved through the industrial ages. So this is the sort of the theory of theory behind the historical part of it.
Okay.
Okay. Now you need to have a general understanding of the financial statements that are being audited, you can say, right?
All right.
I'm sure you're familiar with these financial statements.
Yep, I went through it before.
Yeah, so these are the sort of standard financial statements that are published by any company that is required to do so. And this particular diagram sort of gives the relationship between these various financial statements, right? So you have here the balance sheet, right?
Yep.
Both of these are balance sheet, and then you have the income statement, right? So in most cases, you need these two. These two are like the two main financial statements that you will look when you want to get an understanding about a company's financial status. But a third one, which usually sort of complements that, is the cash flow statement.
Okay.
Right. And here you have a statement of retained earnings, which is, how much of dividends have been paid, and how much of profit has been retained, and it is usually included in the financial statements as well. But this diagram sort of, if you're not familiar how these financial statements are connected, this kind of nicely gives the retained earnings are taken here. This is the retained, and the net income comes from the income statement, and then the closing balance goes to the year-end balance sheet, and so on, right? It's pretty self-explanatory for somebody who's sort of doing financial work, as you would do. Is this understandable?
Yes, it is.
Okay. So obviously we're not going to study about how to prepare these financial statements, right? That's not an objective of this module. You don't need to know that. But when you do accounting for managers, a subject like accounting for managers, something like that, you will need to know how to prepare these financial statements.
All right.
If you haven't done that module already. So who are the parties, or we can say stakeholders, who need to sort of have access to these financial statements? So who are the people who have a stake or an interest in these financial statements, right? Obviously the owners and the shareholders, I mean, they're like the primary most party who needs to have a look at these financial statements, in the sense the information in these financial statements, and people who have lended you money, and people like potential lenders even, right? Like for example, if you are going to a bank or a finance company to receive a loan, then they would certainly need to look at your financial statements, right? So that's why it says actual or potential, right? So even, let's say, even if there are, if it is a listed company, for example, on the stock exchange, and if people, the potential shareholders, potential buyers who would want to buy stocks of your company would obviously look at the financial statements, right? And debenture holders, so these large corporations, they borrow money by issuing these debentures, these sort of guarantees that they would pay back and so on.
All right.
So they are also lenders. And then employees. The employees of companies also need to know the financial status of the company. The customers would, in certain cases, would want to know the financial statements, and even suppliers. Like for example, when you want to sign up a supplier contract, sometimes the suppliers would want to know the financial rigor, how financially stable the company is. And even as customers, like say for example, if you want to, if the other way around, like if you want to put your product, introduce your product to a supermarket chain, a global supermarket chain or a local supermarket chain, they would want some information about your company's financial status. Right?
All right.
So those contracts would require submitting these documents. So these are some of the parties, like the main parties to financial statements. So that.
I just like to check, right? How is it important for the employees to know the financial statement of the company?
Yeah. So let's imagine a large company, and you have employees union, for example, right?
All right.
Now, one of the basic most requirements for them to know the financial statements is to see whether they are getting an annual bonus.
All right.
Right.
Okay.
Like if the company has made a lot of profit, the union, the employees would want a reasonable bonus for that performance, right? That's like a very simple, straightforward thing.
All right.
But not only that, I mean, generally employees would want to know if the company is financially stable, because if it is not, then their employment is at stake.
Understood.
Right.
All right.
Obviously, in most companies, employees, a lot of the employees, especially the sort of the bottom level employees, are not really bothered about these financial statements. They don't even read the annual reports of their own company. Partly because they're not interested, and sometimes a lot of them, like if you take like sort of low skilled workers, if you imagine a garment factory or something like that, or a place where there's a lot of hard labor, they would not have the interest nor the knowledge to sort of read these financial statements and understand them. But if, as you sort of move up the organization structure, when it comes to sort of managers and senior managers, sort of the middle and upper management levels, they must have an eye on the financial statements of the company.
Okay.
Right. And you you invariably get this information not necessarily at the end of the year or halfway through the year, because if you are part of the middle management or the top management, then you have weekly meetings and monthly meetings and sales meetings where you look at your cash flows, for example, right? So that kind of information is current, and you're sort of looking at it anyway. But what you normally don't get to see is the balance sheet.
Okay.
That's where the board has taken some decisions on how to use the money in terms of acquiring assets and so on, and what kind of liabilities are there. So you kind of get the balance sheet idea towards the end of the year when it's published. And sometimes there could be problems there, like you could see that as employees you might find that the board and the top management has been getting huge salaries when the rest of the employees have not been given a salary increase at all.
Understand.
Right? So there are lots of reasons why the employees need to have an eye on financial statements.
Okay, got it.
Right?
Yep.
So what is the need for an audit? Right. So audit gives out a report, right? It's a process, but at the end of the process is essentially a report, and we call it the audit report. Now, why do we need to audit? So the report, that is the financial reports, the financial statements that has been prepared by the company, either internally or externally. And sometimes, large companies have their own internal auditors.
Okay.
Right? Do you have an internal audit department in your company?
Yes, we do.
So there you go. So there's an internal audit department. They do sort of ongoing auditing, and not only on financial statements, but on basically anything, right? It can be a process or whatever, right? HR, facilities, whatever. So they do the internal auditing as well, but still, the final report or whatever report could contain errors, right? So one need for the audit is to identify those errors. And sometimes these reports might not disclose fraud, right? So through an audit, you'll be able to sort of disclose fraud. And sometimes the reports could be inadvertently misleading. That is, that it is not deliberately done. So it can be inadvertently or deliberately misleading, right? Sometimes the people who prepare these financial statements could be deliberately, do changes in the numbers so that it gives that it misleads the owners or whoever the party is that's looking at it, right? Sometimes it can be inadvertently misleading, that they didn't deliberately do it, but there's some information that gives a misleading result. And sometimes some information is not disclosed at all. And very importantly, sometimes the reports and the information that has been provided does not conform to the regulations. Now, the regulations are the national regulations, the industry regulations, statutory regulations, international regulations. So, I mean, imagine obviously every country has their own Companies Act. So this is this, right? Companies law. So Malaysia will have your own Companies Act.
Yeah.
It's probably developed on the British Companies Act, the British law. I don't know. I'm assuming, like, for example, the Sri Lankan Companies Act is is very sort of similar to the British law, because we were a British colony, and that's when a lot of these laws were introduced. So you see that I'm talking about history here.
Yes.
Right. So these are the little things that you can sort of introduce in your assignment, which gives the person who is evaluating the impression that you know what you're talking about.
Okay. All right.
So when you mention about the history and the regulatory environment, write a sentence or two about how the how Malaysia's Companies Act and other regulations that are relevant to auditing came about.
Okay.
Okay. So the reports need to conform to those regulations. Now imagine if your company is an international company, and it has suppliers and customers internationally, and you have so many subsidiaries. So you're a group company, so it's a large multinational organization.
Okay.
Now imagine the kinds of regulations that the company will have to conform to, right? Sometimes you might have to conform to the local regulations if your company has a subsidiary in Brazil, for example, or in the UK, for example. If you are sort of doing business with the EU region, the EU regulations needs to be conformed to. So conformity of regulations is a big thing. But if you are a very small sole trader, a sole proprietor company in most of the countries, sometimes you are not even required to submit an audit report. Right? If you're a if you're registered as a private limited company or a limited by liability company, as we call them, then by law you are required to do an external audit and submit that and record that with the registrar of companies. Right? That's like the general thing. But in some cases, if you are a sole proprietor, then you don't need to do auditing. So it's a broad spectrum, right? And the regulations apply to different companies differently. And if you're a listed company, then it comes with its own regulatory requirements.
I understand.
So these are the different. So the report may have these issues. It may contain errors. It might not disclose fraud. It will fail to conform to regulation. So this is why we need to audit it, to sort of identify those stuff and then take corrective measures, right?
Okay.
Or not. I mean, sometimes. So what happens is, like, once the financial statements are prepared, and when they are audited by an external auditor, the auditor gives a report, right? The auditor is not responsible to correct any of these things, right? The auditor can make recommendations, but that's it. I mean, if the company doesn't want to sort of change their financial statements based on these recommendations, then that's up to the company, right? So the auditor doesn't have any powers to make the owners do something.
All right.
Right. In different countries, of course, auditors have different powers. Right? And we will look at some of the powers in the UK, because you're doing a British MBA, you need to have an understanding about the British law. Right? So the auditor only gives an opinion of the report, and the auditor will identify these issues and will disclose those issues in their report, right? And then it is up to the relevant parties to make a decision on what to do about it.
All
right?
right.
So another need for an audit, another big need for audit is to give these reports the credibility, right? I mean, if the company's own accounting firm uh, prepare the reports, then it's not very credible, right? In the external's eyes, right? But if it has been audited, and if there's an audit report attached to the financial statements, then the credibility of the entire report is high, right?
Okay.
So credibility is another big thing for big need to do an audit. I mentioned earlier that there are, imagine large organizations, groups with so many subsidiary companies. Different companies will have their own accounts teams preparing their own accounts, and imagine how difficult it is to sort of make sure that all these are consistent, and that no errors and or fraud is happening in these different companies, right?
Okay.
So in such cases, you definitely need an external auditor, and that too a very credible external auditor, and a capable external auditor. Because like if imagine if you have a company that is very big, not necessarily an international company, but an organization with so many branches. Like imagine like a bank, right?
Yes.
Or a finance company with branches all around the country, and the auditor might have to actually visit those branches or factories, right? Maybe not all, but at least some, right? So to do that, the auditor would need the manpower to do that to start with, right? So that's, I mean, the selection of auditor is also another part that we need to discuss, and we will do that. So in terms of conformity, these are some of the
Common conformity.
things that you need to conform, like Companies Act is a must. Like it's like a given, and then the financial reporting standards. So different countries will have their own financial reporting standards, and we will look at some of the standards in a bit. Statements of standard accounting practices. So there are certain accounting practices that has been prescribed by accounting bodies around the world. Some international, some local. Does Malaysia have? I'm sure Malaysia has their own sort of chartered accountants.
Yep, chartered accountant you do have.
What do you call? I mean, Sri Lanka has chartered accountants. Sri Lanka. What does Malaysia go by?
I think Malaysian chartered account.
Yeah. So there you go, MCA or something. And then in the UK, you have something called the Financial Services Act. So it's not only the Companies Act, right? Depending, like for example, the audit, you will not find a company calling themselves as auditors.
Okay.
Right? You will find companies calling themselves as chartered accountants. Right? Or certified chartered accountants. Right? That's how they will sort of call themselves. And they provide a list of services. Here, see, they provide a list of services, and auditing is one of those services. So they will do bookkeeping, right? They will prepare final accounts. Usually the audit firm does their own version of the final accounts, usually, right? But not necessarily. They will do tax negotiations, right? They will do all kinds of government form filling, like inland revenue form fillings and all of that, right? They will give financial advice to companies. They will give management and systems advice. They will help you with liquidation of the company, right? If there's a company or a subsidiary that you want to liquidate, then they will help you with that. Sometimes they will help with receivership work, in the sense like buying of companies, of other companies.
Okay.
They will help you with all kinds of other investigations, usually financial, accounts related investigations. Like, say for example, there's a suspected fraud that has happened, right, in one of the branches or in a factory, and you want a specialist to sort of look at it, investigate it, and give a report specifically on that issue, right?
Okay.
So that's an investigation that you can sort of pass on to a chartered accountant's company. And they will help you with financial risk management, and also with corporate governance, because corporate governance has a lot of financial related stuff, but not only finance related. It's about strategic decision making, compliance to so many environmental and other industrial standards and so on, right? And generally best practices, right? Good governance. So they provide a list of services, right? And auditing is one of those services.
All right.
All right. So the reason why I jumped to that slide here is that what they're actually providing, Kira, is our financial services, isn't it?
Yes, correct. All of it.
Yeah. So when they provide these financial services, there are other regulations that apply. For example, Financial Services Act, right? Will sort of stipulate the law that is applicable to when delivering these financial services. So what you will find is that it's not only the Companies Act, but there are many other acts that would apply or that would come into play when you're doing an audit, depending on the requirement.